In my career, during most difficult times in the market, recession times, I know there's a big debate as to whether we're in one or not. And I know there are perhaps political dynamics at work suggesting that no one wants a recession in a midterm election year. But we believe we're in a recession, and I think the evidence is accumulating that the statistics that we're getting fed day to day and to which the market reacts so violently may be very distorted by seasonal factors. And I'll get into that in a moment. But if we're right, then the downturn during the first half of the year, 2 quarters of negative real GDP growth, that downturn might be worse than has been reported. So I'll get into that in a little bit. And it means that the inflationary pressures that are concerning the Fed are probably going to unwind now very quickly. It is true, the last year, against our expectations, has been a very difficult one when it comes to inflation. I never dreamed, given all the new technologies in place to take care of these things, that the supply chain issues that started in April of 2020 would extend for more than 2 years. It's still pretty shocking to me.
Hello and welcome to Money Talks. In today's video, ARK Invest CEO and CIO Cathie Wood updates about recession, economic indicators, fiscal policy, inflation, and innovation. Cathie also updates about her outlook on cryptocurrencies and how the price fluctuations will affect the asset class. Make sure to stick around till the end of this video where Cathie Wood interprets the market signals and explains how innovation is shaping our future.
Well, we had a little reprieve from mid-June to mid-August in terms of the equity markets, at least. And now we're having a test of that rally. So we'll talk a little bit about that. We do think we're in a bottoming process. I know it's frustrating, and I've been in many of these markets. These are bear markets. Anything down more than 20% is a bear market. And at the turning points, it just seems so frustrating. But stick with me as I'm going through the usual drill here, and I want to give you a sense of why we think we're bottoming and what the tug of war is out there and how the evidence is piling up that we are probably moving into a deflationary environment. We're getting real numbers now. This is not just a hypothesis.
Cathie Wood's fans turned tail last month, pulling out the most money from her flagship fund in nearly a year as it continues to flounder. The $8 billion ARK Innovation ETF saw $803 million rush out in August, the biggest monthly outflow since last September. The exchange-traded fund saw daily inflows in only 6 days last month. The surge of outflows underscores a stark shift of sentiment after money flowed in for much of this year even as the innovation-themed fund plummeted. Investor loyalty may now be reaching a limit, with the ETF down 60% this year compared with the S&P 500 index's 18% drop, and prospects dim for a revival anytime soon.
We had a nice rally. Some were calling it a bear market rally. 23%, I think, on the S&P 500 from mid-June to mid-August. And now we're giving back. We thought one of the reasons for that rally was that the Fed was going to pivot and that the market, seeing the deflation in the pipeline, assumed that the Fed would start talking about that deflation. Instead, we got Jackson Hole, and now the market's relapsing. We do think we're in a bottoming phase here because we think we're going to see a lot of deflationary signals that will, at some point, get the Fed to talk about them. It doesn't want to talk too soon. It doesn't want to give anybody any indication that it's anywhere near pivoting. It wants to sound very hawkish, wants everyone to believe that they're going to be as tough as Volcker was in order to get to 2% faster than would otherwise be the case. It could be a lot less than 3% if some of these big retailers start slashing, they need to, prices in order to clear the shelves and put in holiday merchandise. So we'll see in the next few months. As to markets now, so starting with equities, we've talked a little bit about that. As usual, equities are very dependent on a couple of things: profits and valuations. Now, we think profits are going to be hit hard here. More the cyclical part of the world. Our strategies are not biased cyclically. If anything, they're biased completely in the opposite direction. And they tend to do well when overall profit margins are coming down. Now, profits in the GDP accounts looked like the early indications were that they were down significantly quarter to quarter in the second quarter. It seems as though they moved up to an all-time high. What I have found with these metrics around turning points, these metrics and especially employment, is the revisions. If we're really in recession, the revisions are extreme. If you listen to all of the companies reporting, you would not believe that profits are up. Many of them are down and down in a very big way. So again, this dependence on economic indicators, which may be distorted by seasonal factors gone wild during COVID and an inability to adjust them accordingly, could be distorting some of these numbers. The second variable, valuation, very dependent on interest rates, which in turn are dependent on inflation. And you know what we think. But the bears think we're going back to a 70s style inflation and valuations dropping to those levels. That is the essence of the fight taking place, this tug of war as we try to bottom up in the market, bottom out.
Wood and her team have kept to their theme of disruptive technology while managing ARK. That had helped assets in the fund stay sticky earlier in the year since investors knew what to expect with ARK. But Wood's picks have also contributed to the fund's continued underperformance as red-hot inflation and monetary tightening batter growth stocks.
And we do think Europe's in recession, think China's in recession. So the U.S. really is the swing factor here. On a year-over-year basis, gold prices are down 10%. Copper prices are down 21%. Lumber price had gone from $250 per unit of whatever sheath, and all the way to $1,700. Now they're back down to $486, and on a year-over-year basis, lumber prices are down. No wonder housing is in a world of hurt. Energy and food are the sticklers here. Again, Russia, Ukraine. Right now, oil prices on a year-over-year basis are up 19%. But if we stay around this level, given what happened last year to prices, we could be flat by November on a year-over-year basis. Corn today is up 24%. We know the drought and bad yields are contributing to the Ukrainian problem. We know crypto prices, they're down 60%, both Bitcoin and Ether on a year-over-year basis. And it is interesting that they're trying to stabilize in this range while other commodity prices continue to capitulate.
ARK last month snapped up shares of Zoom Video Communications Inc. as the video conferencing company plunged to pre-pandemic levels. The fund has also been buying Ginkgo Bioworks Holdings Inc., which has fallen 69% this year. Some investors may have seen last month as a good time to get out as the ETF rebounded from its June low up until mid-August. But in another indication of bearish sentiment towards Wood's flagship, the AXS Short Innovation Daily ETF, which delivers the inverse daily performance of ARK, saw its biggest monthly inflow since January. So do you agree with Cathie's outlook on recession? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.